Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The Korean story would have been very, very big, but we have got rival bad news from the US. And that's the big story this morning. The global landscape. White House Chief Economic Advisor Gary Cohn has resigned from President Trump's administration over the issue of import tariffs. As well, of course, as I told you, overnight, North Korea said it was open to talks with the US on denuclearization. Very, very important development. In my own view, I think the domestic markets have decoupled and now the Indian markets are moving under their own steam. Arvind Sanger, Managing Partner at Geosphere Capital Management, joins us now. Good morning, Arvind. There may be good and bad news globally, but India continues to fall. Do you think that there is more reason for the markets to fall, or they've fallen enough?
Well, I mean, I think India has its own challenges. And obviously, you were talking a few minutes ago about the bank situation, and that seems to have become the anchor that is driving the market lower. But the global situation has gotten a lot less favorable, and that too is causing a little bit of a pause in the liquidity flow that has been coming to the domestic market. So global investors are nervous about global cues. If global trade war is going to break out, then investment in global markets becomes less desirable or more dangerous, and therefore investors are pulling back a little bit from that. And then India itself is seeing some challenges, although it's ironic that the Indian earnings recovery and the economic recovery seems to be finally starting to move in the right direction, with all of the challenges of the last 12 to 15 months now in the rearview mirror. But global liquidity is a problem, and India banking situation keeps dragging out. And I think we're, fundamentally more optimistic about India, including the bad loan situation, but the political situation in India also, notwithstanding the Northeast results, is going to be challenging this year because of concerns about, what the tea leaves are reading for the 2019 Lok Sabha election. So I think those are some of the reasons why the markets are probably, even in India, not likely to see any kind of a V-shaped recovery and likely to remain somewhat range-bound.
Okay, that's interesting. Arvind, good morning. And from the index point of view, the problem is that some of the urban consumption stocks and some of the financials have the highest weight in the index, and they have led the market rally. So this year, do you think the portfolio focus should be completely different, more towards rural stocks, more towards agri stocks?
I think rural and agri is an easy macro call to make, but I think there are other areas. Clearly, the road and infrastructure sector is an area where we could continue to see more action. The Bharatmala scheme, and then a lot of stuff going on in terms of urban infrastructure, in terms of metros and what have you, as well as potentially a lot going on in the affordable housing. So there are areas, and so I think even some of the NBFCs that are focusing on affordable housing, some of the companies that focus on that, as well as other infrastructure, could benefit. So, and I think the cyclical recovery, as it broadens out, it's been, I think there are many opportunities that are going to come to the front from a fundamental standpoint. I think the macro risks, both on the India political front and on the global macro front, are going to be a headwind. But on the other hand, I think the earnings fundamentals are likely to be more broad-based in a recovery sense. And even the IT sector, which has been, under a cloud, looks like might start to see some signs of stabilization and recovery, and that could be another area that could, continue to rebound from here.
Okay. Arvind, hi, good morning. You mentioned that you don't expect a V-shaped recovery for the Indian markets anytime soon, but do you believe that this is still a bull market correction, or have we entered into a bear market phase now?
I think it is a bull market correction, but the problem with bull market corrections is, they can be very short in duration, or they can be somewhat, dragged out, where hitting the previous highs might take, a couple of quarters. My view would be it's more the latter than the former. But in the end, we're looking for individual stocks that we should buy, and we're looking for, big sell-offs coming out in some of the stocks that we have our eye on. and they can be in a variety of sectors. But the reality is, I think that as an overall market, some of the market leaders are going to have challenges, and that could provide a bit of a headwind for the index to, to go back very quickly.
Okay, so at the moment, what's your sense? Having fallen, 1,000 points from the all-time highs, is it attractive? Are you a buyer right now?
I'm a buyer of individual stocks, and I think I'm finding one or two stocks that have gotten to our levels. There are others that are still a little further away. So I think the market, in our opinion, is not done chopping around in terms of a trading range, and our goal is not to be, we're not worried that the market's going to run away from us in terms of, us missing. So we're being somewhat patient in putting money to work, but we are starting to put money to work.
Okay. Are you a buyer in PNB or any other PSU bank?
Well, we did buy one PSU bank, but we were a little early, but it was luckily in small size. But on the other hand, we own some of the, NBFCs that have continued to do well, although they pulled back a little bit. And then we've nibbled, actually, we've owned one of the private sector bank that's in trouble. But, I think the Axis Bank, ICICI Bank concerns with the two CEOs getting called in terms of the whole PNB inquiry, I think is a bit of an overreaction. My sense is that this whole PNB situation will not drag the banking sector down in the way that the whole NPA situation has. This is a one-off, clearly a failure for PSU Bank, but I'm not rushing in and buying PSU banks, but I am looking at some of the private sector banks that have lagged and looking at opportunities.
Okay, Arvind, I just have to set the record straight. The investigative agencies merely sent a letter to the two private sector banks you alluded to. The letter happened to be addressed to the MDs, but it was not the MDs who went in for the interrogation. It was DMDs and other senior officials. So, I mean, this, as you say, was probably incorrectly reported or incorrectly understood. Mm-hmm. We did try at CNBC TV18 to make it very clear that the letter was merely addressed to the MD, and it was not the MDs who went in for the interrogation. But anyway, that was a minor detail. I wanted to also get your view on this Gary Cohn issue. We've spoken enough about India. Can, the entire protectionism lead into any unraveling in global markets at all? Both Europe, despite what happened in Italy, and the US markets, Wall Street, have not reacted all that negatively. It was a one-day reaction.
Yeah, I think I'm really nervous about global markets because I think what President Trump is doing is playing with fire. And he thinks that by threatening other countries, others will back down. But there is a political dynamic to this threatening countries and asking them to back down, is that the other countries get their backs up and they have to show their voters that they're not kowtowing to the US. And what that can end up resulting in is a global unraveling of what has been a multi-decade growth in global trade. And if you do get a tariffs, or tit-for-tat tariffs, and that escalates, and Europeans put tariffs on some US products, and then US retaliates by putting tariffs on European car imports, as President Trump has threatened, I think the risks here are really high. And frankly, Gary Cohn was one of the most prominent voices speaking in favor of global engagement, global trade, and not doing anything to hurt that. And his departure, in my opinion, raises the risks that miscalculation on both sides, and most probably on the US government side, leads to a trade war. And I think that would be hugely negative for global markets, because global markets have, we've had a 3 or 4 decade growth in global trade and fall in interest rates. If you look at a long cycle, both might be turning on a long-term basis from historic lows in interest rates and historic kind of high levels of global trade. Could we be turning negative in both? And if that turns out to be the case, then the markets are going to face greater headwinds than, frankly, what is so far a modest correction. So that's the one thing that gives us pause in global markets, is the risks of a trade war breaking out.
Okay, and Arvind, as they say, there are no winners in trade wars. In that case, if this escalates, could this be a case where everything is down, commodities are down, exporters are down, even commodity consuming companies are down, could it be that kind of a year if this escalates?
Well, I mean, yes, all sectors could be hurt, but the biggest high flyers have been technology stocks. Now, technology stocks in many cases are also global companies, and I would not expect any global stocks to be left unscathed in a global trade war. And I think, unfortunately, one of the realities, and yes, so I think commodity sectors would not be immune to that. But commodity sectors are not what have led this market higher. And so far, we have not seen China retaliate yet. China has been playing, somewhat the adult in the room as compared to the U.S. in trade. And unfortunately, President Trump seems to have this long-held belief, going back 30 years, if you look at his old interviews, that somehow a trade deficit means somebody else is taking advantage of you. And therefore, the risk is with that deep-held belief that he's going to continue to escalate this. And therefore, if China joins in terms of retaliation and Europe joins in terms of retaliation, the risks are that, certainly commodity sectors, but other sectors could get dragged down, and therefore the overall market could get...
Arvind, we always imagined this kind of a unraveling, even when Brexit happened, that, all of Europe will unravel. Politicians are not so stupid. Will they wait for that? Will they not take damage control steps? Is there a case to buy this dip?
Well, you remember, Brexit was a bunch of voters who were upset about things and made the decision, but the leadership of that time and subsequent leadership of the UK government and of the other governments have been trying to minimize the effect of dislocation on trade. The problem you have in the US is that the leader of the US believes that free trade is bad. That is the first major leader in the world. Brexit was a bottom-up kind of a protest, but the leaders were more sane and adult, if I may call it that. Here you have a US president who is behaving, like the chief bomb thrower. And that, I think, is highly destabilizing. And that's the problem. It's not just the voters saying it, but it is, the president saying it. And that's what makes it so dangerous.
Okay. I just had one question on how to approach the Indian markets now in terms of large caps and mid caps, because the correction in the mid cap space has been really brutal so far. Do you think for the rest of the year, or at least for a major chunk of this year, it's better to stick to large caps, or would you still delve into some of the non-index large caps or the mid cap variety?
Well, I think at the end of the day, good companies are good companies, but I think you make an excellent point. Some of the mid cap valuations have gotten so extreme that I think one of the risks remains that in the sell-off, the mid-cap correction could be much larger. And although there might be a long-term story in many of the mid-caps, if you're going to play the rural plays, you're going to play some of the other plays that you were talking about. There are not too many large caps that give you exposure there, but I think if the risk is that the broader market is going to remain challenged and could go down, then some of the safer bets could be some of the large caps which will get sold off less because either the valuations are less stretched or there is less hot money to come out in those names. So I think in that sense, large caps would be better defensive stocks to own until we get a better sense that the market liquidity, and I think one of the things you have to watch is, how does the Indian liquidity, which has been a one-way street, how does that deal with this volatility? And we've already seen some flows slow down dramatically. So it'll be interesting to watch that. But that's one of the risk factors we're keeping an eye on.
All right.